Hello and welcome to Coins of Wisdom. Today we will talk about inflation. What are the types of inflation? What causes inflation? Why are we concerned about it? And finally, how we can manage our money during inflation. So let's start with a bit of a refresher. What is inflation? A sustained and general rise in the average price level of the goods. Inflation occurs when an economy grows due to increased spending. When this happens, prices rise and the currency within the economy is worth less than it was before. The currency essentially won't buy as much as it would have before. When a currency is worth less, its exchange rate weakens when compared to other currencies. Inflation is also called an arbitrary tax because it lessens people's disposable income while affecting them randomly and taking income from one group and giving it to another. Inflation is simply a means to transfer wealth from anyone who has savings in a particular currency to anyone who has debt in the same currency. The CPI measures the rate of inflation or the price movements of a particular basket of goods and services. Inflation should not be confused with price mechanism, which is the adjustment of prices in response to changing market conditions. What is deflation? A sustained decrease in the price level. What is disinflation? A reduction in the rate of inflation. What is reinflation? An increase in the rate of inflation. What are the types of inflation? There are two main types of inflation: demand pull inflation and cost push inflation. Demand pull inflation occurs when the economy grows quickly and starts to overheat. The aggregate demand increases faster than aggregate supply. Is it easy to fight demand pull inflation? Yes, when we lower the demand, prices will drop soon. Cost push inflation. This occurs when there is a rise in the price of raw materials or higher taxes, etc. Is it easy to control? No, when we lower the demand, it will take longer before the prices start to decline. What is hyperinflation? It is a very high rate of inflation, close to 1000%. A good example is in 1923, German mark inflated from 2000 to the dollar to 4 trillion to the dollar. Now let's discuss what causes inflation. For inflation, the money supply has to increase more than the goods and the services. To understand this, let's discuss the equation of exchange by Irving Fisher. This equation says that the aggregate amount spent by buyers equals the total value of all goods and services in the economy. Mathematically, it can be written as MV equals PQ, where M is the total money in the system, V is the velocity or the rate at which the money enters the system, and P is the price level, Q is the total goods and services in the economy or system. In order to determine the price level, we have to adjust the equation as MV over Q equals P. So which means that in order to control the price, we have to decrease M and decrease V or increase Q. There is nothing wrong with a slow and steady rate of inflation, especially when the inflation rate is anticipated. The situation gets worse if the rate of inflation is unanticipated, as it creates more uncertainty. Inflation has a potential to double the prices of goods and services. For example, applying the rule of 72, which says take any incremental increase and divide into 72, the result will tell you how long it will take the value or the prices to double. So at 2% inflation, it will take 36 years for prices to double, However, at 10% inflation, it will just take over 7 years. Now let's discuss how the government can control inflation. There are many methods used to control inflation. Some work well while others may have damaging effects. For example, controlling inflation through wage and price control can cause a recession and cause job losses. One popular method of controlling inflation is through a contractionary monetary policy. The goal is to reduce the money supply within an economy by decreasing bond prices and increasing interest rates. This helps reduce spending because when there is less money to go around, those who have money want to keep it and save it instead of spending it. It also means that there is less available credit, which can reduce spending too. Reducing spending is important during inflation because it helps halt economic growth and in turn the rate of inflation. There are three main tools to carry out a contractionary policy. Increase interest rates. When the Federal Reserve increases interest rates, banks have no choice but to increase their rates for lending as well. When banks increase their rates, fewer people want to borrow money because it costs more to do so. So the spending drops, prices drop, and inflation slows. The second tool is to increase reserve requirements on the amount of money banks are legally required to keep to cover withdrawals. The more money banks are required to hold back, the less they have to lend to consumers. If they have less to lend, consumers will borrow less, which will again decrease spending. The third method is to directly or indirectly reduce the money supply by enacting policies that encourage the reduction of the money supply. Two examples of this include calling in debts that are owed to the government and increasing the interest paid on bonds so that more investors will buy them. The latter policy raises the exchange rate of the currency due to high demand and in turn increases imports and decreases exports. Both of these policies will reduce the amount of money in the circulation because the money will be going directly in the government's pocket where it can be controlled easily. What fiscal policies we can use to bring inflation down? These include cutting government spending, raising taxes to pay debt, relaxing trade restrictions, and increasing productivity. Now, the most important part is why are we concerned about it? Well, inflation breeds uncertainty, diminishes buying power, erodes real savings, causes unemployment, alters social traditions, and confuses the price mechanism. Because of the redistributive effects of inflation, it increases social and economic tensions. Tensions between labor and management, between government and the people, and among consumers may overwhelm a society and its institutions. Inflation creates money illusion. People think that they have more money, however, their buying power actually diminishes. Inflation creates speculation. If you expect prices to rise, it makes sense to buy things now to sell later at a higher price. Few people will engage in production if it is easy to make speculative profits. People may be encouraged to withhold resources from the production process, hoping to sell them later at higher prices. As such behavior becomes widespread, production declines and unemployment rises. Bracket creep. Under the progressive tax system, taxes go up when income rises. Bracket creep is the movement of taxpayer into higher tax brackets or rates as the income grows. Inflation tends to increase everyone's income, pushing them into a higher tax bracket, which means people lose more money or they have less money for themselves. Hence, savings, investments, and work effort decline. Unemployment concerns. The government might have to restrain spending in the economy to keep prices from rising. This could lead to cutbacks in production and an increase in joblessness. To put it in perspective, a little bit of inflation might be the price the economy has to pay to keep unemployment rates from rising. Or some unemployment may be the price society has to pay for price stability. Who is hurt the most by inflation? Anyone on a fixed income is hurt the most by inflation. How does inflation affect lenders and borrowers? Lenders are hurt more if the inflation is unanticipated as the risk is not managed before. Borrowers are hurt more if the inflation is anticipated because lenders manage their risk accordingly. How are investors affected by inflation? Because investors make decisions based on expectations, unanticipated inflation leads to uncertainty and a decline in investments. So now let's discuss how we can manage our money during inflation. As we know that the income minus the expenses equals savings. This is valid for individuals, group, companies as well as countries. So we need to think of ways to increase our sources of income and reduce expenses. Once we increase the savings, we can think of investing the amount in diversified sectors to distribute the risk and have better returns. Most people would believe that cash is the safest investment, but during inflation, it is not. It is rather a risky investment. So one has to think differently that stocks and bonds are not the same. The cash is not the same. Dalio said in his interviews that diversification is more important than ever. And he said that do you want an asset class return or do you want a portfolio of well balanced assets? So, the most important thing for investors is to think about diversification of asset classes, diversification in different countries, and diversification in different currencies. So, when you are thinking of investing, invest in the competitive countries, in multi asset investments, and in multi currency investments. Because wealth is not so much destroyed as shifted from one asset class to another. Thank you very much for sticking around with me until the end. I appreciate that. If you like the video, please click a like button and consider subscribing to this channel. Share this video with your friends who are trying to understand inflation. Thank you very much and I'll see you next time.